My name is Keith Delaney, and I'm here today to teach you about portfolio management in another lesson on financial literacy. But first, before we begin, let's take a look at our table of contents. We can see that we're going to first define terms, and then we're going to learn about investment styles, and then we're going to move on to portfolio management styles, and then conclude with final takeaways. So our first question, what is a portfolio by definition? Well, by definition, a portfolio is a group of one selection of investment assets, whether that be stocks, bonds, real estate, etc., etc. Some other terms that we're going to use in the lesson are index. Index is defined as in the stock market, index is a method to track a group of stocks selected by certain standards. Another term we're going to use is index investing, which is when investors don't try to guess the future moves in the individual stocks or in the market as a whole, but instead buy an index and hold it. The two most famous indexes are the Dow Jones and the S&P 500. And then our final term that we're going to go over today is market timing, which is pretty much when you move in and out of a financial market and or switching between asset classes based on investor predictions. So let's move into the investment life cycle. Let's try to think about different periods in one's life and what that means from a financial standpoint in that time period. So you have your young adult, and in that cycle you're going to be going through some sort of education, whether that be college or some sort of apprenticeship. And then you have ages 25 to 40, which we label as the young professional. So you might be bouncing around between jobs. You might have a steady job, steady income, but you're going to have most of your earning in this time period. And then there's the mid to late career, ages 40 to 60, and late career / retirement, ages 65 plus. So accumulation happens early in life as someone begins accumulating their investments in a building portfolio. So when we go back to the other stage, we think of the accumulating stage from like the young adult to the young professional. And then the consolidation stage is when people have usually paid down some of their debt and begin thinking about retirement. So you see this in the latter half of the young professional life cycle, as well as the mid to late career cycle as well. And then finally, spending. You no longer have a steady income, but instead you spend your life savings, etc., in retirement. So that's going to be your late career investor life cycle. So in general, as a life cycle progresses, investors become more and more risk averse. So also note that there's a gifting phase that I didn't really include here because some people don't even reach that point in their life, but this is pretty much when an investor gives their assets to others. But let's continue to different investment styles. So we know that investors have different goals at different ages, so we know that their preferred investment styles can vary as well. The two most prominent investment styles are passive and active. Passive, which is also called index investing, which we defined earlier. An index in the stock market is a method to track a group of stocks selected by certain standards. It measures the performance of stocks in certain industries based on the selection of these standards. Index investing means investors don't try to guess the future moves of individual stocks or in the market as a whole. They instead buy a portfolio that invests wholly according to the style of this rule. So think large stocks / growth stocks and you hold it. So the goal of this is pretty much to match the returns on a pre-specified benchmark index. So when we think of passive, think risk averse, not very risky. Active, on the other hand, attempts to beat the return on that index using judgment and trading skills. This involves an active process of stock selection. Active investors also choose to predict the short-term moves in the benchmark or individual stocks. This is often referred to as a process of market timing, which we defined earlier. To define it again, which is it's moving in and out of the financial market and or switching between asset classes based on investor predictions. So a fun fact, if you look at net returns after deducting expenses, only 25 to 33% of active investors outperform passive investors. So that's really important to look at. But if you are a very skilled and wise active investor, you can make a lot more money and really destroy the return on the index. So it's a risk some people are willing to take. So a passive style generates fewer transaction expenses in general, so it involves less trading, so that's a big advantage to passive style, whereas active investing might bring higher returns if the investor is skilled in stock selection, so kind of what I was saying before, as well as timing the market. But what if the investor has little or no skill? Well, the answer to that question is if you're active investing, the risk becomes increasingly high and your chances at beating the index are very low. So, moving on to portfolio management styles. There's essentially 4 different portfolios, or 5, that you can create. And the first one is the aggressive portfolio. The aggressive portfolio seeks outsized gains and accepts outsized risks. It also usually selects companies that are in the early stages of their growth and have the potential to rapidly accelerate earnings. Think of this like investing in Apple when it was just in the garage. So most of these companies that you're investing in the aggressive portfolio are not yet a household name, so you wouldn't be investing in the Apple that we know today. The defensive portfolio, on the other hand, generally does well in bad times as well as in good times. So in those economic recessions, such as in 2008 and the Great Depression. So the defensive portfolio usually selects companies that make products that are essential to everyday life. So think consumer staple products, and a great company is Coca-Cola. And these consumer staples, these commodities, are usually pretty steady even in times of recession. Thirdly, the income portfolio. It focuses on investments that make money from dividends or other types of distributions to stakeholders. An income portfolio should generate positive cash flow. It also often selects stocks that have fallen out of favor but have maintained a high dividend policy. REIT is a great example, which is a real estate investment trust. It's pretty much a security that's treated like a stock and invests in real estate. Because REITs receive special tax consideration, they may offer investors higher yields. Investing in an REIT is a liquid dividend-paying means of participating in the real estate market. REITs give investors the opportunity to invest in real estate without requiring a large investment. So, the income portfolio also includes utilities and other slow growth industries that are an ideal place to start your search. And the next portfolio is a speculative portfolio. It takes the most risks among these 5 styles and is the closest to gambling. So when I think of the speculative portfolio, I like to think of the recent GameStop phenomenon. But a speculative portfolio could include IPOs or stocks that are rumored to be takeover targets. So think like Wall Street Bets. Wall Street Bets, it's rumored that GameStop was going to be a takeover target. It was. So if you invest in that, you are kind of turning your portfolio into a speculative one. But further, it could also be tech companies that are developing a breakthrough product or healthcare companies that are waiting for an FDA approval on one of their drugs or a vaccine, like the COVID vaccine. You have Pfizer. And the final portfolio that we're going to talk about today is a hybrid portfolio. And this combines stocks, bonds, commodities, and even art. It has a diversification across multiple asset classes. Traditionally, this type of portfolio would include a core of blue chip stocks, so think companies like Apple, Coca-Cola, as well as some high-grade government or corporate bonds. So when you think of hybrid, think diverse portfolio. So some takeaways and conclusions. Portfolios usually include a variety of investments because diversification is a way to manage risk and smooth out the volatility of investment returns. Secondly, a number of factors determine what to put in a portfolio. For example, the financial goal, the timeline in which this goal needs to be achieved, and risk tolerance. And what we talked about, all of that is related to your age and what stage of life that you're in. And portfolio management styles vary per investor. And that's all for today. So thank you guys so much for listening. I hope you learned something. Go out there with this information and succeed. Thank you.